Greetings everyone. I'm your facilitator Rajat Kush, and in this training we are going to discuss about option contracts. So for this training, I have divided this whole training into three segments. In this module, we are going to talk about the basics of the options contract. In the second module, we'll be covering options payoff profiles, and in the third module, we'll be touching upon few strategies which you can use in the options market. So let's start. A financial option are contracts that give the holder, the buyer, the right to buy or sell an asset without an obligation to do so. That means, let's say a person A purchased an option. That means if this option goes up in value, he is going to make a profit. But if it goes down in value, he has to do nothing. He can just walk away from this contract. It will expire worthless. You can have options on equities, bonds, even options on futures, options on indexes, commodities, and currencies as well. Let's look at some of the terminologies of the option. First of all, let's say a stock A is trading at a price of 10. It is very much possible that this stock has also options, and now option strike prices are 8, 9, 10, 11, 12. So now it is up to you that which strike price you want to choose for your particular option. This will be your contract price. Option holder is someone who is actually buying this option, but we do not say buyer of an option, we say holder, because buyer becomes confusing when you talk about put option. Then the person who writes this option, sells this option in another way, is the person known as option writer. Now, as I mentioned that if A makes profit, he will get the profit. But if A does not make profit, in fact, he makes a loss, he doesn't have to pay on those losses. So why would anyone enter into such a contract? Because on day one itself, A is going to pay B some money in advance. This is what we call as option premium. So an option premium is the income received by the investor who sells or writes an option, because you are taking a risk that if option goes up in value, you have to pay. But if it goes down in value, no one is going to pay you. So why would you enter into such a transaction? Because you are receiving some money upfront. The contracted price is called the exercise price or the strike price. The maturity period is called the expiration date. Call option is the option where a person gets the right to buy an asset. Whereas put option is an option where the person who is holding the option gets the right to sell the asset. All right. So holder of an option, if call option, right to buy. If put option, right to sell. Whereas writer of the option, in a call option, he has an obligation to sell. Why obligation to sell? Because he has the right to buy. And in a put option, obligation to buy. Why obligation to buy? Because this person has the right to sell. There are different types of options available in the market. Basically, there are two types which are mostly used across the world: European and American. So European option is an option which anyone can exercise only on the expiration date, not before that. So let's say today is 1st June and you purchase this option, you bought a call option, and the expiry is 30th June. So you can close your position only on 30th June. So that is European. American is an option where you can close your option anytime you want before expiry, right? So that's your American option. So question, the right to sell an asset without an obligation to do so is called a put option. The right to sell. Yes, it is true. Call option, right to buy. Put option, right to sell the asset. Options moneyness. Now I have shown here the table for moneyness for call option, and here I'm going to write the moneyness for the put option. Okay. So what is a moneyness? Let's say you purchased an option with a strike of 10. Okay. Strike price 10. And the spot price of this asset is right now 10. Okay, so this is your spot price of, let's say, stock A, and this is an option on stock A. So you selected strike price 10. Okay, so now since strike price is same as spot price, this option is called at the money. Strike is equal to spot. Now let's say this stock starts going up and now it is trading at 11. So now since it is trading at 11, but you purchase a call option at 10, that means it is profitable by 1. So if strike price is less than spot price, your option is in the money. Okay. What if this stock went down and now it is trading at 9? So you have the right to buy this stock at 10, which is trading at 9. So you are in a loss. So if strike price is more than spot price, your option is out of the money. Okay. Now let's talk about put. Put is exactly opposite of it. Put is right to sell. So let's say you purchased a put option. That means you have the right to sell this stock. Okay. So here it remains same. If put is at 10, your strike is at 10, spot is 10, then strike price is equal to spot. So at the money, same like call option. But now if stock has gone down to 9 and you have the right to sell at 10, that means you are profitable by 1. Why profitable? Let's assume you do not even have the stock. You can immediately purchase it for 9 and sell it for 10 because your contract price is at 10. So if your strike price is more than your spot price, your option, put option, is in the money. All right. What if stock has gone up to 11? It means that you have to purchase this stock for 11 and then deliver it to someone at a contracted price of 10. So you are in a loss. So if strike is lower than spot, your put option is out of the money. So option premium is the income received by an investor who writes an option. Because he is taking the risk, he should be compensated for this risk, and this compensation is provided to him by the buyer, holder of the option. What are the components of your option premium? There are basically two main components: time value and intrinsic value. What is intrinsic value? If, let's say, option has a strike price of 10 and this stock is trading at 11, and we are talking about, let's say, call option. So this option is already profitable by 1. That is its intrinsic value, right? But let's say there are 30 days to expiry. Now, lot many things can happen within these 30 days. So a seller will not sell the option, will not write the option by just taking 1 dirham, because 1 dirham is already profitable. He is taking extra risk for next 30 days. So he needs more compensation. Maybe he needs 1 dirham more. So this 1 dirham more which he is charging will be for time value. So together this option premium is worth 2 dirham if strike is 10 and spot price of the stock is 11. So let's look at the summary. Options are the contracts that give holder the right to buy or sell an asset, whereas the writer of an option is obligated. So if option buyer or option holder wants to buy, he has to sell. If option holder wants to sell, he has to buy, because in both the condition he is obligated. An option premium is the income received by the investor who writes the option. So since you are taking an obligation, you need some compensation. So this compensation is your option premium. Call option is the right to buy an asset, whereas put option is the right to sell an asset. Option premium is equal to time value plus intrinsic value. In fact, let's say this is the last day of maturity and the market is about to close. Just 1 minute is left. Your strike price is 10 and spot price is 10.5. So what should be the option premium? It will be very close to 0.5, because call option is profitable by 0.50 dirham or 50 fils, and there is no time left. So maybe it will be trading at 50 or maybe max 51 fills for one fill for last 1 minute. That's it. Okay. So this is your option premium. So this is the end of module 1. Hope to see you in module 2.